Four times the charm, it seems. On Tuesday, MSCI decided to include 222 China A-shares in its emerging markets index. That would represent roughly 0.7% of the overall index. Now, to get a sense of the significance of this decision, I spoke with Brendan Ahern, who is the Chief Investment Officer at Crane Shares here in New York, that has an exchange-traded fund that includes A-shares. This is what he had to say.
Yeah, I mean, it's a historic moment for China just to be included in MSCI's indices, which is the gold standard for institutional investors globally. So it's a major, major step in the institutionalization of China's onshore equity market.
So why did MSCI say yes this time around? Well, Ahern believes it's a combination of demand from its clients that want greater exposure to the Chinese mainland and the fact that they only included A-shares traded through Stock Connect that links Hong Kong to Shenzhen and Shanghai. By going that route, this allows for fewer capital restrictions than if they were to buy them directly from the Chinese mainland. However, Ahern says there are still some minor issues that still need to be ironed out.
China does still allow companies to temporarily halt their securities, which can be problematic for daily liquidity providers like an ETF or an index fund. But I think those are minor issues. In the long run, this is going to set off the first domino to a much, much larger weight of China for investors' portfolios globally.
222 stocks will initially be included, but Ahern believes many more will be added over the years, which would likely push the A-shares to roughly 17% of the index. So what happens next? Well, in May of 2018, which is when the changes will be implemented, all of the index funds and the ETFs that track the MSCI Emerging Market Index will have to go out and buy those A-shares. So there's roughly $1.6 trillion that tracks that index. 0.7% of that means it's not going to likely be a substantial influx of capital, but that's just passive investment. In the meantime, active investors like hedge funds and large pension funds will likely want to get ahead of the trade, so we could see substantial trading activity in those A-shares in the days to come.